Hi, welcome to my channel Management Accounting Made Easy. This is Standard Costing and Variance Analysis Part 7C. Here we are going to see labor planning and operational variances using a numerical example. We are going to see a numerical example for labor planning and operational variances. So we'll see the question. An ice cream company makes quality ice cream. This year, the company has decided to make different flavors of mochi ice cream for the first time. So the data is given 50 ice cream in a batch. The company has employed 26 employees. Each work 142 hours per month, paid $15 per hour. No idle time recorded for the month of June. Total labor cost for the month of June is $59,072. Employees were given 4% pay rise at the beginning of the year. The standard rate per hour doesn't include this pay rise. Estimated time to make each batch is 9 minutes. Because of the new incentive, employees are expected to complete in 7.5 minutes. Budgeted production is 45,000 batches. Actual production is 38,000 batches. So there is a change in the rate and also there is a change in the time. Calculate the labor planning and operational variances. So we are going to calculate the labor rate planning variance. There are two methods. So I'm going to do both methods and you can pick whichever method you like. So this is method 1. Under method 1, we uses the number of hours worked. So under method 1, we use the number of hours the employees have worked. So we look at the question. There are 26 employees. Each work for 142 hours per month and they're paid $15 per hour. So, but the employees were given 4% pay rise at the beginning of the year, but the standard rate of $15 doesn't include this pay rise. So we'll see. Labor rate planning variance. So we are going to compare the original budgeted figure, which we call it X and T. So each worked for 142 hours, times it by there are 26 employees. So 142 hours times 26 employees. And this is the total number of hours they worked for. According to the original standard, they are paid $15 per hour. So 142 hours times 26 employees times $15, which is equal to $55,380. This is our X and T figure, original budgeted figure. Now we'll see the revised budgeted figure. We call it X post. So 142 hours times 26 employees. Okay. Now we need to include the 4% pay rise. So $15 times 1.04. That means we are including the 4% pay rise. You will get $57,595.20. I'll quickly repeat the ex post figure. 142 hours, 26 employees, times $15, but we have to include that 4% pay rise, so increase, so which is 1 times 1.04. So you will get $57,595.20. So the material price planning variance under method 1 is $2,200. $215.20 adverse. Okay, we have calculated the labor rate planning variance under method 1. Now we are going to calculate the labor rate operational variance under method 1. So the question again, 26 employees, each worked 142 hours per month and paid $15 per hour. This is according to the original standard. And there was a 4% pay rise. And also they have given the actual labor cost for the month of June is $59,072. Okay, so we'll calculate the labor rate operational variance using method 1. So the standard rate, we must use the revised rate, which is $15 per hour times 1.04. So that's the pay rise. So $15 times 1.04 is $15.60. So that's our new standard rate. So $15 times 1.04, as I told you before, which is equal to $15.6, times it by 142 hours, times it by 26 employees. So according to the revised standard, our total rate should have been $57,595.2. But if you look at the actual rate was $59,072. So the labor rate operational variance is the difference between the revised standard rate and the actual rate, which is $1,476.80 adverse. So this is the labor rate operational variance under method 1. So we are going to calculate the labor efficiency planning variance under method 1. So we'll quickly have a look at the question. Estimated time to make each batch is 9 minutes. Because of the new pay incentive, employees are expected to complete in 7.5 minutes. Actual production 38,000 batches and paid $15 per hour. So we'll see the labor efficiency planning variance under method 1. So we are going to see the ex ante figure, which is our original budgeted figure. 38,000 batches they have produced. According to the original standard, 9 minutes per batch. So if you convert that into hours, which is 9 divided by 60 hours. So 38,000 times 9 divided by 60, we will get 5,700 hours. Now the revised budgeted figure, which is our ex-post figure, 38,000 batches, but according to our revised budget, each batch should take 7.5 minutes. So if we convert that 7.5 minutes into hours, 7.5 divided by 60. So now our revised budgeted figure or our ex-post figure is going to be 38,000 times 7.5 divided by 60, which is 4,750 hours. So we have a 950 hours favorable variance. Now, as we know, we need to convert that into money value. Remember, this is method 1, so that's why we have to times the 950 hours by the original figure, which is $15. So 950 hours times it by $15, which is $14,250. $250 favorable. We are going to calculate labor efficiency operational variance under method 1. So again, we look at the data. Estimated time to make each batch is 9 minutes. Because of the new incentive, employees are expected to complete in 7.5 minutes. The company has employed 26 employees, each worked 142 hours per month, and they're paid $15 per hour. Actual production, 38,000 batches. So as usual, we need to compare the time allowed with the time taken, and then the difference, we need to convert that into money value. Okay, the time allowed. So 38,000 batches, we should take the new time allowed, which is 7.5 minutes. So divided by 60, because we are converting that 7.5 minutes into hours. So the time allowed, which is 38,000 times 7.5 divided by 60, which is 4,750 hours. That's the time allowed. But the time taken is 26 employees, each worked 142 hours per month. So 26 times 142, which is 3,692 hours. So the difference is 1,058 hours favorable. Now we need to convert that into money value. We are using method 1. So this 1,058 hours, times it by $15 per hour. So our labor efficiency operational variance is $15,870 favorable. One good thing about this standard costing is we can cross-check our workings and see whether we have made any mistakes. So we'll see. If I add all the variances, all the planning and operational variances we have calculated, so we have our labor rate and labor rate operational variance under method 1, and labor efficiency planning variance and labor efficiency operational variances. These are all we have calculated under method 1. And we are getting a total variance of $26,428 favorable. Okay, now we are going to see whether we have done our workings correctly. So if you look at the actual standard cost, which is the original standard cost, which is 38,000 batches, according to the original standard, 9 minutes per batch. So 9 divided by 60. We know that we are converting that into hours. So that's why 9 divided by 60 times $15. So we get $85,500. I'll quickly repeat that again. 38,000 batches times 9 minutes divided by 60 times it by $15. So we get $85,500. And the actual cost is $59,072. So the labor cost variance is $26,428 favorable. So our workings are perfect. So here we are going to see the method 2. Under method 2, we are going to use the number of units produced, okay, or number of batches made in this example. But when you compare method 2 with method 1, out of the 4 variances, labor rate planning and operational variances, labor efficiency planning and operational variances, only 2 variances are going to be different from method 1. So we are going to see only those 2 variances. One of the variances which is going to be different from method 1 is labor rate planning variance. So we'll see. The original time for per batch is 9 minutes. The new time is 7.5 minutes per batch, and the original rate $15 per employee hour. And also they have given a 4% pay rise at the beginning of the year. Actual production 38,000 batches. So we'll see the labor rate planning variance. Okay, so this is the rate variance, labor rate planning variance. Original budgeted figure, this is our ex ante figure, 38,000 batches. Okay, 7.5 minutes, this is our revised time. We need to convert that into hours, so divided by 60, times it by $15. That's our original rate per hour. So you will get $71,250. I'll quickly repeat that. 38,000 batches times 7.5 divided by 60 times by $15. So that is $71,250. But the revised budgeted figure, which is our exposed figure, 38,000 batches, 7.5 minutes divided by 60, times it by 15, that's our original rate, but we need to include the 4% pay rise, which is times it by 1.04, you will get $74,100. So if I'll quickly repeat this again. 38,000 times 7.5 divided by 60 times it by $15 times it by 1.04, you will get $74,100. So the labor rate planning variance under method 2 is $2,850 adverse. We are going to see labor efficiency operational variances under method 2. So we look at this question again. 9 minutes, the original time allowed per batch, but the new time allowed is 7.5 minutes per batch. 26 employees, each worked 142 hours per month, and the original rate is $15 per hour. Actual production 38,000 batches. So we are going to calculate the labor efficiency operational variance under method 2. Okay, we know the efficiency variance. We need to compare the time allowed and the time taken. So the time allowed here is 38,000 times, remember we must take the revised time because this is the operational variance. 7.5 minutes divided by 60, so we get 4,750 hours. Time taken, 26 employees times 142 hours, so 3,692 hours. So we get 1,058 hours favorable. Now, under method 2, when you convert that efficiency variance into money value, you got to times it by the revised rate, which is $15.60. The revised rate is $15 times 1.04, you get $15.60. So 1,058 hours times it by 1560, you get $16,504.80 favorable. This is our labor efficiency operational variance under method 2. Okay, like before, we are going to cross-check our workings under method 2. So I'm going to list all the 4 variances. So labor rate planning, labor rate operational, labor efficiency planning, and labor efficiency operational variances. So these are all the variances we have calculated, and the total variance according to our calculation is $26,428 favorable. Remember, under method 1 and method 2, our calculation will be slightly different, but both methods are right. So we are going to see the standard cost, which is $85,500. 38,000 batches times 9 divided by 60 times $15. So that is 85,500, but the actual cost is $59,072. So the labor cost variance is $26,428 favorable. So whichever method you follow, the calculations will be right. Thank you for watching. Please do remember, you have to practice as many questions as you can. If you like this video, please like, share, and subscribe. I'll see you in part 8 of standard costing and variance analysis.